Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. Over the next 30 minutes, we try and talk about two key topics that people are bothered with currently. One is the significant underperformance of select mutual fund schemes year to date. Secondly, the reclassification that has happened in the mutual fund industry and the impact that it has had on various schemes, and so many investors wondering about whether or not they have done the right thing by sticking to the funds that they invested in before the reclassification happened. Now, I'll start off with the underperformers and outperformers. And if you just take a look at the statistics out here, will come up on your screen in moments from now. These are 3 or 4 funds. We've just chosen them based on the kind of numbers that they have doled out this far. YTD, Axis Multi-Cap Fund up about 7.2% in a year like this. Axis Equity Fund up about 4.9% in a year like this. Reliance Vision has had a slightly tough time, and Sundaram Small Cap Fund has lost about 13.8% of their NAV YTD. However, the key to monitor or the key to note is that what is underperforming right now need not remain an underperformer, and therefore it becomes very important to get in experts to try and talk about what do some of these underperformers and outperformers could do, if at all it's possible to predict, and what should you as an investor do if you are a holder of some of these funds. To talk about that, Kunal Bajaj, founder and CEO of Clear Funds, and Tarun Birani, founder of Thinkman.in, joining us on the show. Gentlemen, both of you, good morning. Good afternoon, rather, and thanks for joining in. Tarun, let's start off with you. Perennial case of underperformers and outperformers that we'll find almost every single time. Yeah. Should investors who are invested in these schemes or some of the other schemes be concerned with the kind of underperformance that some of the schemes are showing?
Sure. So, Neeraj, the whole exercise of identifying underperformance and outperformance need to have some fundamental logic behind it. I can see year-to-date data to review a fund underperformance or overperformance, according to me, is not the right way to look at it. Plus, the objective with which these categories work need to be understood before making any comment around underperformance. So I have realized, and we did a small research study internally, wherein mid caps on small caps as a category, at least minimum requires 7 to 10 year minimum horizon to meaningfully make a underperformance or overperformance kind of statement. Large cap as a category requires minimum 4 to 5 year kind of track record, multi-cap between 5 to 7, because that is the time horizon where we have seen the top 20 or top 25 schemes. The return gap between them is hardly 2 to 3% between that. So I think rather than getting into a last 1 year, 6 months or a 2 year kind of exercise, I think the objective and the suitability part for the investor is much more important.
Yeah, the reason, though, Tarun, is that there are so many queries which are coming in about people saying that we invested in this and the NAV is down about X, Y, Z percentage or Z ticks from where they invested. Why is this happening? And I think which is the whole effort of AMFI as well, right? To say that mutual funds sahi hai, but keep the patience. And I think which is why this topic was chosen, that whether or not people should be bothered, and do some schemes only have a market impact, or do they have some specific reasons because of which they are underperforming?
So I would say this is more on the behavior side. It is more like a herd mentality bias. Just because the markets last 3 years have been doing so well, there are a lot of investors which just got caught and felt left out and they invested. And that's where they have not done the suitability exercise well for themselves. They just invested because a friend has done, or somebody else, or media is highlighting some good performers. So I think the basic exercise need to be done more around your own suitability. And if that is done correctly, and 10 years you don't need that money, I don't think a 1 year, 6 months, 2 year underperform is going to matter any which ways. And I think our regulators have done a great job in terms of figuring out how to educate investors and all those over a regular period of time. So I don't see much problem around that.
Okay, Kunal, do your thoughts differ significantly?
I agree with Tarun, broadly speaking, but I think we have to recognize that most of the investors we are seeing in the market at this point in time, the inflows have been fabulous. The benefits of an SIP have been explained all over the media and by AMFI as well. But we have to recognize that a lot of the investors are first-time investors. Have they understood the concept of risk properly, or has that been explained to them? We're not really sure about it. So if someone is asking us whether they need to change their asset allocation or whether they should come in or come out of a scheme, I think it's an important question to answer. And some of the names that you mentioned, I think it's important to address that question. Firstly, does the scheme fall within the purpose that it's meant to perform in your portfolio. And if it is within that purpose and it's performed in line with, for example, a small cap scheme in line with the small cap returns, then there's nothing to be concerned about. But on the other hand, if it was meant to fulfill a particular goal, for example, give stability to your portfolio, but it's behaving completely erratically, that's when I would look at it and say, look, this is something that is probably not right for you.
Okay, now Kunal, you've given us this table of how the different schemes' performance has been over the last 4 or 5 years, trying to, I think, explain why people should have this long-term scenario into account, not just to invest, but also to analyze what the performance of different schemes are. Let's just get the table on the screen. This is various categories as devised by Morningstar: ELSS, flexi cap, large cap, and small and mid cap categories. And it shows the kind of performance that some of these schemes have had over the past 4 or 5 years, right? This is till May. Kunal, what are you trying to explain via this?
Sure. So this is the tax saving scheme, the most popular ELSS scheme that people tend to get into at the end of the year when they're rushing to save taxes, and for good reason. But it's important to understand that even in equity schemes, I think what people tend to expect is that, when the advisor tells them or they look at the long-term returns and they say 10 rupees invested 20 years ago is now worth 1,000 rupees, for example, the returns are not in a straight line. There is variability in the returns. There are years in which you will get 3% and you wonder, should I be holding this because I make 6 or 7% in the bank? In a sense, what I'm saying is, this is not like Dravid taking a run every single ball. There will be a few big pinch hitter years where you'll find people hitting the ball out of the park. There will be years in which nothing happens, and you need to be prepared for that volatility. If you're not ready to stomach that volatility, then this product is not for you.
Oh, okay. So, 3 or 4 examples out there before, and then I'll get in Jayesh in. So, ELSS tax saving, if you just look at what they've done over the last 4 or 5 years, then flexi cap, the returns, and then the large cap and the small and mid cap. And the small and mid cap chart, and both of you can come in. There's an example given by Kunal, of course. The small and mid cap fund returns. Is the bout of underperformance that we're seeing thus far in 2018 a result of a significant bout of outperformance of the previous 4 years? Both of you, Kunal, let's start off with you.
Sure, I think so. I mean, very, very clearly, there has been a craze to buy small cap, particularly because of the kind of returns you're seeing. 2014 was a staggering year. 2017 was another great year after positive returns for 4 out of the last 5 years. Clearly, we run an online mutual fund advisory and transaction platform. And one thing we do notice on our platform as well, that people come in and they sort by 3-year returns and want to buy the best performing fund. That's human nature. That's something that we try to nudge people against, but that's human nature. You need to guard against that. You need to realize that even tall trees don't grow to the sky. And just because small cap has outperformed large cap over certain time periods doesn't mean it will go over and continue indefinitely. In fact, what you're likely to see is some amount of mean reversion. At the beginning of this rally in 2011-12, the price to book, or a simple way to think about it, is how expensive small cap was versus large cap. The differential was the largest ever, in the sense that small cap was ridiculously cheap. That differential has largely gone away over the last few years. So will the large cap companies just roll over and die? Will the cyclicality in the Indian economy go away? No, it hasn't.
No, it won't.
We found that 2013 has repeated itself in 2018 in the form of a twin deficit, current account and capital account, and fiscal deficit. Sorry. So I think investors need to recognize that and not just chase momentum. Unfortunately, it's easier to say that than to actually change that behavior.
True.
We've seen that in every market cycle, and that repeats yet again.
True. Tarun, any thoughts here?
So on the small cap side, it is very clear this is a high risk, high reward kind of product, and that requires a much more longer horizon. And 1 year you could see 100% return, on 3 years you could see a negative returns. So unless the investor is not ready with that kind of performance, I think they should not venture into something like that. Because we have seen last 5-year returns on a CAGR basis, you would always see annualized returns of upwards of 15 to 20% return. But nobody talks about those 4 bad years, let's say a 2008 or a 2013 bad year, I think, where they have seen a 30-40% erosion also. So unless unless the investor is not ready with that kind of, I think, because you don't know, right? Next 1 year, despite all these good data, there could be some event happens and there could be some situation which can emerge. So that's where investor need to be very clear cut that a mid and small cap category, unless you don't have a 10-year plus horizon, we would recommend against that category, because otherwise that wealth creation as an objective will go away. It would be too transactional a motive. So we would rather look at as a wealth creation as the bigger objective, and to achieve that, a suitability right exercise done and good funds identified with good parentage, I think you will achieve the wealth creation.
Okay, we'll try and do that as well. But first, remember last week, Jayesh Kilnani was doing a couple of pieces on the top underperformers and top outperformers. And while we've seen these underperformers and outperformers of the year, it's also important to note how some of these have generated wealth for investors in the longer run. Both our experts are talking about that. Jayesh has some more details. Jayesh.
So Neeraj, let's have a look at the list that we had culled out last week. Some examples over here. If you have a longer term horizon, what the guests are also talking about, just to prove their point with some numbers. So we had Access Equity Fund. Now this year to date has been an outperformer. But if you look at a 5-year period, it has generated CAGR of in excess of 20%. And over a 9-year period, it has given you about 17.9% in the last 9 years as well. The other few categories that we had, which was the underperformers, Sundaram Small Cap Fund, of course, over a 5-year period, it has given you CAGR of nearly 25%. This year, it may be down about 13-14%, but have a look at the past data that we have, and over a 10-year period, excess of 21% CAGR delivered by this fund. Same is the case with the DSP BlackRock Small Cap Fund, or the Microcap as it was popularly called before. Over a 5-year period, 12.9%, and over a 10-year period, 27.2% is the CAGR return. Now this compares to the Nifty or the broader market that we generally refer to. So Nifty has given you about 11.5% in 5 years and about 13.9% in the last 10 years. So definitely, in each of these categories, outperformance over the long term does exist.
Okay, Jayesh, thanks for putting that into perspective. So, gentlemen, in which case, you would know the schemes which are underperforming and outperforming in the back of your hand. What are your views on some of these? And for people holding these schemes, more importantly, the underperformers, what should the view be? Kunal, if I can start off with you.
Sure. Actually, we spoke about a couple of schemes that Jayesh pulled up on the screen. One of them is the Sundaram Small Cap scheme. The good thing about the scheme is it's true to label. So small cap as a category has been doing quite poorly since about October, November last year. And as long as the scheme stays true to label, it's forms a particular part within the investor's diet. The way I like to think about it is, it's almost as if you're having a thali, and you have a little bit of protein, you have a little bit of grain, carb. You have a little bit of, you need to, you go complete protein diet and you want to become a bodybuilder in a year, I think that's unhealthy as well. You don't want to have a complete, sattvic kind of diet as well.
Sure.
It's no fun. So you want to find the right balance. If this is the right, if you're looking at small cap, it's a scheme that I would continue to hold, given the fact that it should, play a very small role in your overall allocation.
Interesting. Tarun, you want to give an example? I think you wanted to speak about the ICICI Value Discovery Fund, if I'm not wrong, or is that something else?
So, Value Discovery is one scheme where we are getting a lot of queries from investors. So, last 2 years, this scheme has underperformed by 50% compared to the basic Nifty Sensex.
Wow.
And but again, to look at the objective of this strategy is the entirely contrarian strategy. So they always look at buying something which is valued today, which market today may not value today, right? So the pharma and FMCG, which last 2 years, the beta environment we were in, I think those two sectors have underperformed, and these funds, this specific fund, I have seen 10% of the holding is in a single stock called Sun Pharma. Yeah. So this fund manager is super convinced about that contrarian play, what he's playing. And looking at his 5-year and 10-year horizon, he has always given double of the benchmark kind of returns. So that's where setting right expectation of investor is very important, because these 2 years we have ensured each of our client, we have told them this scheme has been taken with a 7-year plus horizon, 2 years, 3 years, the scheme will always give you lower returns. Yeah. So once that expectation has been clear-cut mentioned, I think these 2-3 years underperformance, year-to-date data and all that will not matter or will not touch, because that's where the experience of investor over a long period of time is going to, setting right expectation, that is going to matter a lot. Talking about which schemes to take and all, I think if you are a very medium risk kind of investor, don't venture into mid-cap kind of strategies in next 1 year, because this next 1 year is going to be full of data points wherein elections, a lot of crude data, a lot of US data, negative data, trade data is going to come on an everyday basis. So if you don't have the penchant for that, avoid mid and small cap strategy per se. But if you are a long-term investor, I think you can venture out. Yeah.
Okay. Viewers, also keep in mind, for example, in a value discovery fund, I mean, I'm not using that as a benchmark, but just using that as an example that if your time horizon for investing into mutual funds is 3 years, and that's a good enough time frame as well in certain cases, in certain periods, then maybe such schemes are not apt for you. And therefore, this whole idea of trying to map what scheme works for you for the kind of goal that you have before you go out and invest into it. So if Tarun Birani is saying value discovery fund is a great scheme, if your time horizon is just 2 years or 3 years, it may not be the best scheme for you. If Kunal Bajaj is talking about staying on with the Sundaram small cap fund, but if your time horizon is the next 1 year, maybe you got to rethink, but do consult your financial advisor before you take any of the calls, even on those that you've heard on this show. But that's as far as the underperformers and outperformers go. A lot of queries that have come into us about the reclassification that has happened, the recategorization that has happened in mutual funds, and I think that's what we'll talk about over the next 10 odd minutes with both of our experts. Okay, so guys, let's try and solve this puzzle which is in the minds of everybody. And Kunal, this time around, start off with you. This categorization and reclassification. Now, a lot of people have tweeted about this, that hey, I invested in, for example, I'm just using an example, in HDFC Prudence Fund, and suddenly the name has changed, the nature of the scheme has changed. What do I as an investor do?
Right.
What would your response be to the, not using this as an example,
sure,
but the overall reclassification, reorganization, recategorization, whatever you call it?
So let me spend a couple of seconds just explaining what is happening over here. What SEBI has really done this time around is say that mutual fund needs to be true to its own nature or its own label, right? So if you are a large cap fund, you need to stick to large cap. So an easy way for a large cap fund to generate outperformance or excess returns is by drifting away from its original style and by saying, look, let me just buy a little more small caps because small caps are doing well and that adds significantly to my returns. This classification exercise actually boxes all the funds in and says if you are a large cap fund, then stay large cap. At least 85% of your investments needs to be in large cap. That's actually extremely healthy in the long run, because what it does is it helps advisors like us find the right product by mixing a whole bunch of things to create a balanced diet. Otherwise all you're doing is tracking it every single month and figuring out, okay, this guy actually said he will be large cap or a value fund, but value isn't doing too well, and he's drifted away from that and turned his style completely different. That's not what SEBI wants you to do. SEBI's rightly saying that stay true to whatever you call yourself. That's the background. What's happened since then is that every mutual fund has been forced to choose. It's almost as if we went in there saying these are the different uniforms you need to wear. Pick a uniform, and now you have to wear that uniform for the rest of your career, the life that you have. In this particular case, what's happened with HDFC Prudence is they had two balanced funds. One was HDFC Balanced itself, and the other was HDFC Prudence. What happened with HDFC Prudence is it's changed the category completely and gone into Balanced Advantage. Balanced Advantage is a very, very different category from what Prudence used to be. Prudence used to be a 75% equity, 25% debt fund. We've spoken to the management at HDFC, and it will continue to remain a 75-25 equity debt fund. They have no plans to change that. But Balanced Advantage is a completely different animal, if I could say that. You can go from 0-100 equity debt to 100-0. So in a sense, if HDFC Prudence stays 75-25 forever, someone else who is more nimble in this category and says, the market isn't doing too well, I'm going to change my asset allocation a lot more dynamically to take advantages of opportunities in the market, will benefit. That's what we expect will happen. So this is not, if you're looking for a 75-25 fund, then this is probably not the right category for you to be in. You're probably better off looking elsewhere.
Okay, and I'll get to particular categories as well, but just an initial thought from you, Tarun. What does this do? You know, the part two of my question would also be, there's somebody in my office who was saying that the scheme has been recategorized.
Sure.
If I don't want to be here, I have to book money out of that scheme.
Sure.
That makes me subject to some bit of taxation, I would presume, whereas otherwise I wouldn't have been. Could there have been a better way to handle this?
Yeah, so let me come to the first question on the categorization part. I could see a pattern around this entire categorization. The first leg of reforms which has started on the distribution side, with the entry load going away, the direct plans entering and all that. And the second leg of the reforms are happening more on the fund management, which is currently happening. And I see mutual fund as a product has been positioned as a very simple product, but when we go deeper, it has been made so complex, wherein there is room for a lot of manipulation around it. So SEBI has taken a right step in terms of creating a simple structure, a template, wherein there are 32 templates which has been defined, 10 in equity, 16 in debt, 6 in hybrid categories. So you can be only in these templates, otherwise you have to figure out how you want to do that, right? So now there is a set template, and every template has a written code and protocols which has been defined, and you can't do anything else. Earlier, when I could see many funds, sometimes they used to become large cap, sometimes they used to become multi cap. They used to always juggle around, and because based on the market opportunity, they used to tweak around. But as an advisor and as an investor, I have given money with a certain objectivity and certain bit of mindset, right? And if that changes, I think my whole purpose get lost. So this classification is one of the best things to happen for the mutual fund, and this will, yes, for investor, the next 1 year is going to be extremely challenging because what performance they are watching, I think, is not the correct one, because the data is not correct right now. Yeah. So next 1 year we have to live with that. After 1 year, things will start be much more sane, I would say that. Yeah.
You subscribe to that?
Well, I think so. I think actually,
You can differ, by the way.
Yeah, what's clearly happening is that you will see a lot of these recategorizations which have already happened. I think by the end of this month, the entire exercise is complete. And like I said, each fund, as Tarun said, there are 32 different uniforms that are available. You have to pick one of those and wear them. And now you can compare every fund wearing that same particular uniform and saying, okay, now of these 17 or 18 chaps that are wearing this particular code, large cap, which is the best? And that becomes really easy for a customer to implement. What it does is actually make sure that with a little bit of thinking, with a little bit of self-education, I think it also helps the customer being more informed.
Okay.
And an informed customer, to me, is always the right kind of customer to have.
What about the tax bit that somebody pointed out?
Right.
Any of you?
I think it's unfortunate that the tax bit is just a reality, that if your fund is changing category dramatically and doesn't fulfill the role it was playing in your portfolio, then the right thing to do is to sell it and take the hit, the tax hit. That's just the harsh truth and the only way to go about it.
Yeah, in terms of exit loads, I think if you do under that period, your exit loads will not be charged.
Can you explain that? Sorry.
So there are two kind of costs which an investor can incur, right? Exit load if you are going before that time horizon, and second would be the tax cost.
What is the time horizon?
So time horizon differs from category to category. Equity as a category more than 1 year is something erstwhile used to be a long-term capital gain. Today we talk about 10%, yeah. And debt as a strategy, 3 year plus is something what is recommended. So anywhere, I don't see much of the disruption, at least on the debt shorter end. On a longer end, there are a lot of stuff, but I think their investor can continue where they are and let them complete that 3 year horizon. On the equity front also, I don't see any meaningful disruption for investor bearing some 3 to 4 schemes where investor can take an informed call and move ahead.
I was actually going to ask you guys, have you in this whole study figured out a scheme or two which has completely changed color? We are not branding them as a good scheme or a bad scheme. Just talking about the color or the uniform, as we are talking about, has completely changed. Have you guys spotted anything?
So HDFC was the Prudence was the first category, and it's more than 25,000 crores of asset under management. So this fund earlier used to be a classic balance category fund, and today it is moving to a 0 to 100% kind of equity level kind of fund. So this, as a category, it goes lower in a risk profile where it used to be. So now this is much more favorable for a conservative investor compared to the earlier so-called aggressive.
You agree with that?
No, I don't. I think they've stated very clearly that they will continue to run the same 75-25.
Okay.
So from my perspective, nothing changes.
No, so 75-25 they have stated, but as an objective, tomorrow fund house can always change that.
Sure.
So for an investor, he should be aware of that.
Okay, fine.
Because
So
it
that
can
is
go
one.
to 0 to 100 at any point.
Okay.
Yeah.
So that is one. Any other schemes that any of you have spotted?
Yeah,
Either?
ICICI Dynamic Fund again is as a strategy has moved as a multi-cap asset fund. So earlier, as a multi-cap, multi-asset fund, you need to have 3 assets under the portfolio. So now they have a gold, equity, debt. 3 different category where they have to have minimum 10% exposure in any of those category, and they can move as high as 90% in any of those category. Earlier this fund used to be a debt and equity kind of category. So this is again a big sea change for investor, I would say, because gold was something which was, if investor is something not looking that as a asset class to enter, I think then investor need to decide how to go about
So
that.
would you recommend any of your clients who didn't have that objective to get out of this fund and go into some other suitable fund?
Yes, I would say so. But it will continue to be an asset allocation because earlier also it used to keep moving the equity based on the asset allocation matrix what they used to have, and they will continue to do that. But added thing is the gold part. As of now, like he mentioned, 75% is what prudence they have stated they will do. Fund house is claiming that they will continue to have this 10% kind of thing, but that can anytime change based on the market thing. The investor need to be aware of
Actually,
that.
this is one thing the only time I'll differ with Tarun. So I think ICICI Multi-Asset Fund is an exceptional product. And the reason is, in a year like this, for example, gold has been a great outperformer. And gold performs a very unique position in the portfolio, in the sense that it dampens a lot of the volatility. This year, for example, gold funds have done well. I think they're up about 6% the year to date as a category. And what the multi-asset fund category does is say you need to have at least 10% in 3 categories. And the 3 categories, you have 5 choices. You have equity, debt, gold, commodities, and real estate, which is REITs. So if the fund manager gets a little bit of gold over there to adjust for the volatility and give smoother returns to the investor over longer periods of time, that's a fabulous product.
No, so nobody's debating that. The question is, did the Pru Dynamic have that flexibility?
It didn't have that flexibility earlier.
So somebody who wanted to invest in the Dynamic, this is a far change from what it used to be.
It is certainly a change, but it's a change where you've got probably one of the best asset allocators run by Naren of ICICI Pru, who's got a great track record in doing exactly this.
Yeah, which is why I started with the question saying that, this is not
product.
about whether the fund is good or bad, but otherwise. Kunal, one last question to you. I think HDFC Top 200 is another scheme that you've pointed out as something wherein there has been a change. Can you explain that?
So HDFC Top 200 was benchmarked to the top 200 stocks, and now this has become HDFC Top 100. And it's become a large cap fund. Now, in a large cap fund, you have to hold at least 85% of your assets in large cap stocks being the top 100 stocks. Earlier, their allocation to large cap versus mid cap was about 65% large cap and about 30-35% in mid and small cap. So certainly there is a change over there. It will behave much more like a large cap fund, which will probably dampen a little bit of the returns over longer periods of time. It's not something that we're saying buy or sell or get hold. There's no real opinion on it, but really that people should understand that the fundamental nature of this scheme. And it's a large scheme in terms of the assets they manage. That fundamental nature has changed.
Do you defer, Tarun? Final answer?
So on this, I agree to that what he's talking. But earlier they used to do a lot of mid cap as a strategy to increase the returns of the portfolio. Now investor need to have a sane expectation. It's a pure large cap play now, right? 85% of the portfolio will always have 100 stocks, top 100 stocks.
Wow.
Yeah.
Okay. So that's a sea change as well. Gentlemen, but the good part about this conversation is that, including me, I think a lot of investors would now have an idea of what this whole recategorization, reorganization has meant for their portfolios as well. And thank you so much for putting light to that. So 2 vital topics that we've discussed. Tarun Birani, Kunal Bajaj, thank you so much for joining in today and giving us those perspectives. And viewers, thanks for tuning in today. You may have had some queries. I haven't had the time to take them, but request you to write into them. We'll try and ask our advisors to maybe respond to them through the various social media platforms on Bloomberg Quint. But thanks so much for watching this show.